Good morning. In today's webinar, we are diving into one of the most powerful tools in advanced retirement planning. That is voluntary after-tax contributions to a 401k. Whether you are a high income earner trying to stash more for retirement, or you are exploring the mega backdoor Roth strategy, this session is for you. Please make sure to subscribe to our channel and turn on notifications. We go live daily with expert content on solo 401ks and IRAs. Here's what we'll be breaking down today. What are voluntary after-tax contributions? How are they different from Roth and traditional contributions? Which plans allow them and which don't? How do they work with the mega backdoor Roth strategy? Are there any risk or tax traps to avoid? So stick around because we'll also cover how to check if your plan allows it and what steps to take if it does not. All right. As always, today's daily webinar is for educational purposes. Please go ahead and make sure to subscribe to our channel for more topics like this. So what are voluntary after-tax contributions? Voluntary after-tax contributions is a way of indirectly getting more Roth IRA funds into your 401k, whether a traditional 401k or a solo 401k, which is a type of plan for the self-employed. With the solo 401k plan, it allows for various contribution types, such as pre-tax contributions, Roth contributions, and voluntary after-tax contributions. Or Roth and traditional 401k or solo 401k contributions different from voluntary after-tax 401k or solo 401k contributions? For one, it's a way, as I mentioned already, to go beyond your typical Roth 401k contribution limit. From a employee side of things, you can make employee Roth 401k contributions or employee Roth solo 401k contributions, which is a total of $23,500 for tax year 2025. So by using the voluntary after-tax solo 401k or 401k contribution feature, you can contribute above that 23,500 employee Roth 401k contribution for tax year 2025 by making just voluntary after-tax 401k or solo 401k contributions. Or you can make your employee Roth 401k or solo 401k contribution, and then the difference up to the overall limit, which is $70,000 for tax year 2025, can be made as a voluntary after-tax 401k contribution and then converted over to the Roth 401k. So today's webinar, we're discussing not only voluntary after-tax contributions to a solo 401k, but also to a traditional 401k, a traditional 401k being a 401k that's offered by a full-time employer, whether it's Home Depot or Microsoft, to name a few. Those companies offer 401k plans. Whether or not those traditional 401k plans allow for voluntary after-tax 401k contributions really depends on whether or not those entities have composed a 401k plan document that allows for not only voluntary after-tax 401k contributions, but also if it allows for processing in-plan Roth 401k conversions. Because the voluntary after-tax 401k contributions are used with the mega backdoor Roth 401k strategy. And in order to utilize the mega backdoor Roth 401k strategy, your plan has to allow for one, making voluntary after-tax 401k contributions, and second, it has to allow for in-plan conversions of voluntary after-tax 401k funds to the Roth 401k. Now, switching gears to a solo 401k, not all solo 401k plan providers provide a plan document that allows for the mega backdoor Roth strategy, that is for both voluntary after-tax solo 401k contributions as well as in-plan Roth conversions. Providers that do not allow for such a strategy are typical solo 401k companies like Fidelity, Schwab, banks that offer solo 401k plans, and even some trust companies that may offer solo 401k plans. However, with the solo 401k plan from my solo 401k financial, they do provide a solo 401k plan that allows for the mega backdoor Roth solo 401k strategy. So for example, if you open up a solo 401k with a company like my solo 401k financial, you can choose to make pre-tax contributions, Roth contributions, voluntary after-tax contributions, or you can even forego making employee and employer contributions and solely make voluntary after-tax solo 401k contributions, which is $70,000 for tax year 2025. That's the overall limit to a solo 401k. So, for example, let's say that Jason is self-employed. His self-employed business is an LLC, taxed as an S corporation. Jason opens up a solo 401k plan that's sponsored by his self-employed LLC that's taxed as an S corporation. Jason chooses to solely make voluntary after-tax solo 401k contributions as part of the mega backdoor Roth solo 401k strategy for 2025. So for 2025, the overall contribution limit is $70,000. Let's further assume that Jason pays himself at least $70,000 of W-2 wages from a self-employed LLC. Therefore, Jason can contribute the entire $70,000 of gross W-2 wages as a voluntary after-tax solo 401k contribution, and subsequently turn around and convert that $70,000 voluntary after-tax solo 401k contribution to the Roth solo 401k holding account or to a Roth IRA. You get to choose. Most clients will convert it to the Roth solo 401k so that they can keep all the funds in the solo 401k plan, as solo 401k plans are often used to consolidate retirement accounts. And also the solo 401k plan is not subject to require minimum distributions on the Roth solo 401k side. And from an investment perspective, if you utilize a non-recourse loan for investing in real estate, because the solo 401k does allow for investing in real estate, and therefore it allows for using debt financing. When a solo 401k utilizes debt financing, it does not trigger unrelated debt finance income tax, which is a tax that does apply to Roth IRAs that utilize a non-recourse loan for investing in physical real estate through an IRA, also known as a self-directed IRA. But that does not apply to self-directed Roth solo 401ks or self-directed pre-tax solo 401k plans. So again, go ahead and shoot over any questions you might have during the live session here. We'll pause and answer those questions as they come in. And also make sure to subscribe to our channel here for more notifications as we go live on a daily basis and cover content regarding not only solo 401ks, but also the business financing 401k and IRAs. So, are there any risks or tax traps to avoid when making voluntary after-tax contributions to a 401k? Well, not necessarily. I mean, number one, before you do make a voluntary after-tax 401k contribution, make sure that your traditional 401k plan provider allows for it. From a self-employed perspective, make sure your solo 401k provider does allow for voluntary after-tax solo 401k contributions. So there's really no risk except making sure that the plan you have allows for it. So, and also make sure that when you make that voluntary after-tax solo 401k contribution, that it's deposited to a separate holding account within the solo 401k plan, because you are required to separately track each source of funds in the plan as well as each participant's funds in the plan. So for instance, if you open a solo 401k plan and you want to just utilize the Mega Backdoor Roth solo 401k strategy, you want to make sure that you make the voluntary after-tax solo 401k contribution to the holding account under that solo 401k labeled voluntary after-tax. And then subsequently, when you convert those voluntary after-tax solo 401k contributions to the Roth solo 401k bucket, it needs to be converted to a separate holding account within the solo 401k plan titled Roth, and that will complete the Mega Backdoor Roth solo 401k strategy. So those are items to understand when determining whether or not you can make voluntary after-tax contributions to a traditional 401k, aka a 401k offered by a full-time employer, versus a solo 401k for the self-employed. I don't see any live questions here in the live session. Well, thank you again for joining today's daily webinar. We'll be back again live tomorrow. Until next time, have a great rest of the day.